Welcome to the Daily MBA, where business wisdom is served fresh and fast, straight from one of the top MBA programs in the world. I'll give you summaries of my lectures and readings, as well as the most important insights gained from an MBA, so you can apply all of this knowledge in every business. Let's get started. My last episode, I finished it with a bit of suspense because I was going to explain how should we invest according to the modern portfolio theory. Just after I told you all the process we have to do to see what is the fair price of a stock and to value a firm in today's price. So, how should you invest now that you have all of this money? There are many theories, and one of them, it's not even a theory, this is a fact, that humans are risk averse. We dislike risk, yet we like high returns. So this is presenting a big trade-off that's called the risk-return trade-off. If you had two options and you had to choose one that's going to give you a better return, you would choose that, obviously. And let's clear the table again. If you had two options and one of them is going to give you risk, the other one's going to give you less risk, as humans, we would also be biased to taking the less risk one. The thing is, when we compare these two options, they're not matching. Investors are going to require a higher return in order to take more risk because we dislike risk. And that's why all of the sayings in finance are saying you either sleep well or eat well, because you can be relaxed, taking no risks, but you're not going to be getting as much return as you could if you took riskier decisions that don't let you sleep but are giving you very good return. So this is going to be an important trade-off that we must consider because why? Investing is very personal and emotional. There's people that are more risk-averse, so they should have that in mind because when market goes down or when things start getting hard, emotions are going to start playing a hard role on yourself. So you should know that risk aversion is going to play an important role in this process. But so, going back to science and finance and all of these models, we're going to start seeing that every asset, is going to have two things. On the one hand, an expected return, and on the other hand, a volatility return or a risk measure. And the thing is, we're going to start plotting all of the possible assets into a graph that's measuring those things. Return on one hand and then risk on the other one. And we want to see what is the correlation between putting assets together. And so why am I talking about correlation now? Correlation matters more than you think. Because when you're buying any asset, let's say I'll take two random ones. I'm going to buy Google and I'm going to buy Boeing. So these are probably very uncorrelated. Airplane manufacturing, this one is creating a completely new thing than Google on the cloud and not having any hard manufacturing going on. These two companies are probably not correlated, or at least not as strongly as I would believe. But the thing is that correlation will determine the risk of the portfolio. Why is that? Because if I have Google and Boeing or Airbus or whatever airplane manufacturer I want to choose, this is going to be balanced out. So let's say one day tech industry goes down, I still have my hedge. I still have this Boeing or Airbus asset that is my little savior. And then maybe tech goes up and then like COVID, no more airplanes are needed to be created. Airbus would go way down. But then I would have Google to save me over there. So the lower the correlation that you have between two assets, then you are minimizing all the risk and maximizing your return. Therefore, a bad asset may be unattractive if it has a low correlation. And I'm going to put this also into real life terms now, not assets or not stocks. But let's just imagine you have 2 coins and someone says, you can pay me $10 for flipping each coin. And if they fall on heads, you'll get $20. If not, you'll get nothing. What if you could tape the 2 coins together? One option would be taping them the same way. So this would mean it's a correlation of 1. Either they both fall heads, they both fall tails. What is this going to give to you? A very high risk. Because when you throw it, you already paid 20 for throwing both of them, and you may have 0 or you may have 40. So it's incrementing all your wins. What if you don't tape them? You have them uncorrelated. So now they don't have a correlation of 1, they're just not correlated. You're just spinning one, spinning the other one. Maybe sometimes you'll win, sometimes you'll lose. This is going to be a bit less risky. But then, this is the best part, what if you could tape them, one facing up and the other coin facing down? This would be a correlation of -1. And so this one would be the correlation every portfolio would be seeking for. Because I paid 10, and for sure, I'll get 20. It doesn't matter which side will fall, you'll always get 20. Because if one side falls on tails, you get the other one falling heads. And if this other side had tails, the first one had heads. So they're always balancing each other out, and this is giving you 0 risk, and then the return that's expected. This is basically the theory that's going to be behind all the stocks in a more elaborate form. But it's the same concept. If you manage to have small correlation or even negative correlation, which is kind of harder to have, this would reduce your risk and would give you higher profits. And that's why most people believe diversification is one of the best things that you can do. And once Bloomberg wrote an article which was very well written, they said there are not bad stocks, there are just bad correlations. Because that's really the point here. You just have to find a correlation that's going to be saving you when things are going back on the other end, and then will be, even if the other one goes bad, the first one will be the one saving you. So diversification is going to be an important factor that you should consider, because if you have less correlation, it's going to protect you against risk. First important point. Second important point, this correlation was plotted out by some financial person and was used for creating the efficient frontier. So what is the efficient frontier? This is supposedly the set of portfolios that are going to give the highest return when you have the same level of risk. So the efficiency frontier, when plotted, looks almost like a C. So you have some things going down, and then it turns and goes back up. And this is plotted in a graph that's giving you returns on the y-axis and then risk on the x-axis. So if you have more risk, let's say here, but you're giving less return, why would you ever invest here? You always need to invest in the top part of my finger. This would be the efficient part. And that's why it's called the efficient frontier. So it's supposedly, we're already assuming every investor, if you can have more return for the same type of risk, you would of course prefer more return. Okay, and now I'm going to put a photo because I know my finger graphing is not very good, but you can watch it if you're listening to this podcast. Let's imagine now we put a risk-free asset. So risk-free, it's going to mean that it has 0 risk, so it won't be anywhere down. It will just have return. And we drew a line that will cross the market frontier. It will cross it in just one specific point, like the tangent line, if you remember that about high school. And this specific point, where the Capital Allocation Line, as it's called, and the efficient frontier meet, is in the entire market portfolio. So in this point is where you'll get the most return, let's say, without risk. And this is very consistent from everything we've heard about Warren Buffett or Ray Dalio or any big investor out there that's advising us. Just if you don't want to take the effort to do all of the analysis I already showed you, it's better to just buy an ETF that's tracking the S&P 500 or the entire stock market or an international stock market, however you want, but follow the entire market. That's going to give you very good returns with zero risk. So this is basically a financial demonstration and scientific demonstration of why this is the best. But also, what if you combine it with the risk-free asset? And this is going to allow investors to move now this capital allocation line that you're seeing on the screen throughout this red line. And so you can either have less risk with a little bit less return, or you could have more risk with more return. And how can you do that? How can you invest even more than the market? This is basically by something that wouldn't be very smart doing today because rates are high, but it would be by borrowing at the risk-free rate and then investing more in the market. So you can even keep pushing that frontier. So if I could borrow at the risk-free rate today and then invest at the market, and I know the market is going to give me more return than the rates today, so that would be a bit harder because today rates are expensive, that would be the best portfolio that you could ever create. The thing is, you also have to consider what's going on and what's the reality with borrowing rates, risk-free rate. But also, this is the theory behind why most big investors, like Benjamin Graham in The Intelligent Investor, suggested having a little bit of both. So he is moving more towards the left of this red line, and he's going to allocate, depending on the moment of your life, like 50% on bonds, so risk-free, and then 50% on the stock market. And this combination is the one that you can modify as you're aging, as soon as you have more money, as soon as you can take more risk. So me, for example, I'm young. I could take probably way more risk than someone that's about to retire and needs their money. So I could take an approach, 80% of the market and then 20% only bonds. But then someone may want to do the opposite, 80% of bonds and then 20% of the market. If you do 100% bonds, you would be in the corner of the risk-free. If you did 100% of the market, you would be in the market combination. The thing is, you have to find the fit wherever you are, depending on your risk tolerance level. And so, how do you do this, or what are the implications for all of the investors? First, the optimal portfolio will always be diversified and will have low correlation assets. If you opt to not go in the market, then you would have to consider these two characteristics, diversified and low correlation. Then the second one, it also includes a risk-free asset and the market portfolio, so you can fall in that efficient line, let's say. And third, the proportion of the market versus risk-free, it's going to depend on each individual, as I said at the beginning, because this is something very emotional. So it has to be on your risk-bearing capacity. So my last advice on stocks, and for this I'll close everything I have to say about stocks, would be how can you invest like this? And my advice wouldn't be mutual funds, wouldn't be having any advisor with you. You already watched my videos. It would be through ETFs. ETFs are low cost, they're cheap because they are not a person that's picking the stocks specifically, they're automated, and you can get a big market portfolio like symbol VTI, but you could also get just S&P 500 portfolio, which is almost the entire US market, important market, let's say. The symbol is VOO. Then you can also even get ETFs for the risk-free portfolio. There's an ETF that accounts for all the bonds, and it's called with the symbol BND. So you could even buy an ETF for holding bonds. And then you can even have a combined one, because all of these big companies are also reading about these theories and they already developed it. They already figured it out for you. You don't even have to think. So there's one in Canada called VBAL. And this one is going to hold approximately 60% equity or market and then 40% fixed income or risk-free. So these are all options that you can take risk-free or at least risk-reduced in a very low cost. So this is all I have to say about markets. If you have any questions, you can drop them in the comments. And I'll see you next week to talk about something even harder, which are options.